Okay, now we will talk about the formula how to get to the free cash flow to firm. Here is the formula, right? The free cash flow to firm equals to EBIT after tax, right? Or net operating income after tax. So you subtract with tax, add back with depreciation, because we talk about cash, right? Depreciation is non-cash item. So we group up item EBIT after tax, add back with depreciation, we get what? Operating cash flow, right? Operating cash flow. And then subtract with the new capital expenditure, right? Increase in capital expenditure or CapEx, and then subtract with increase in net operating working capital, so that we get free cash flow. So what should be the root definition for free cash flow to firm? Free cash flow to firm is the cash that available to all investor, right? All investor, right here we means what? Bondholders, preferred stockholder, and common stockholders. After you pay for new CapEx and new net working capital or increase in working capital, so whatever left goes to those investors. That's why we call free cash flow to firm. And how do you get EBIT? EBIT, you know, is already, right? Look back at this equation. EBIT equals to what? Sale minus operating expense, right? Sale minus cost of goods sold minus operating expense, you get EBIT. And then you subtract with tax, right? Subtract with tax. And then add back with depreciation. So how do you get depreciation? Here is the formula to get depreciation. Annual depreciation expense equals to cost of equipment plus shipping and installation. So these two we'll call depreciable asset, right? Cost of equipment plus shipping installation. And subtract with expected salvage value. How much do you expect to sell when you use it at the end of the useful life, right? And then you divide by the useful life of the equipment, you get depreciation. Example, consider a firm that purchased an equipment for 500,000 and incurred an additional 50,000 for shipping and installation. So depreciable asset will be 550,000. What will be the annual depreciation expense if the equipment is expected to last 10 years and have a salvage value 25,000? So use the formula, right? Substitute number into the formula. You get what? Annual depreciation 52500 per year. Okay, so when sale increase, you know, right now we will talk about how to calculate a project working capital requirement, right? So when sale increase, you might sell by cash or sell on credit. Firm's account receivable balance will tend to grow, right? In addition, new project may lead to an increase in firm's investment, right? In inventories. So both lead to the cash outflow. So you got to pay cash based on increase in working capital. And here is how to calculate investment in net working capital equals to increase in account receivable plus increase in inventory. Okay, so those two items are current asset minus with increase in account payable, which is current liability. So this one is the investment in the net opening working capital. Next one, you need to calculate the project capital expenditure requirement, right? So when the project is over, you use it until the end of project life. We add the salvage value of asset to the final year's free cash flow, along with liquidated working capitals, anything left into the firm, right? You have to sell it. Okay, so this is the what terminal value or terminal cash flow.